And then lastly, it's the hyper consensus short duration rate trade peak. What I'm showing in these in these panels is the bill yield minus the similar maturity overnight index swap rate. And so when you have a negative reading, it's telling you that investors are crowding into bills relative to where they should be priced. Zero, this should be a zero in terms of where they are, but they're very clearly crowding into bills because there's a collateral shortage on the short end of the curve. Well, it seems like it's peaked on a 3 month basis. Seems like it's peaked in terms of the short duration trade has peaked on a 6 month basis and a 12 month basis as well. So we'll see. I think this is one leading indicator that, hey, look, you're probably, at the bare minimum, the smart money and fixed income is now starting to bet on duration. But again, it doesn't mean you can't go from here back to here, from here back to here, and from here back to here. Again, I do want to just let's give it a couple more days, give it a couple more weeks, or until we start to really see some momentum breakdown in inflation, momentum breakdown in European inflation surprises, and more importantly, our VAM signals themselves telling you that it's incrementally safer to allocate to these positions, like it did in China, particularly for those two exposures that we have in the portfolio construction. Leading indicators for core PC suggest maybe at best in terms of the short duration trade peaking. And then what I mean by this is, we still got 6.2% 3 month annualized median CPI. That's the median change of everything in the CPI basket. 6.5% annualized sticky CPI. Both of those numbers are, still north of the year on year. So the year on year is going to continue to accelerate until you get a real breakdown in terms of the momentum. We still have not seen a real breakdown in the momentum. 6.2, 6.5, only 20 basis points down month over month, only 10 basis points down month over month. These are the April CPI statistics. It's telling you that it's a maybe at best in terms of this short duration trade. It could get worse. And it doesn't necessarily mean inflation has to go higher. It just means that the market has to suddenly get spooked about the Fed's resolve. Again, incrementally spooked about the Fed's resolve to fight inflation. I think the market last week got incrementally less spooked. They got incrementally sanguine about the Fed's resolve to fight inflation from a levels perspective. And that could obviously start to go back in the reverse direction at any given time, just based on their commentary